Okay, let's go.
All right, welcome to The Explainer. Today, we are pulling back the curtain on the market's hidden mechanics. You know, that secret playbook that leaves so many retail traders feeling completely frustrated, like they're being hunted and just left wondering, what in the world just happened? So let's kick things off with a feeling that I bet every single trader out there knows. Way too well. You've done your homework, you place a trade, you do the smart thing and set a stop loss. And then, what happens? You watch the price creep down, it hits your stop loss to the exact penny, and then, boom, it immediately reverses and rockets up in the direction you knew it was going to go. It's absolutely maddening, isn't it? Okay, but what if I told you that wasn't random, that it wasn't just bad luck? What if it's actually a deliberate process, a totally engineered event? Well, it is. And to understand how it works, you have to grasp one single crucial concept. Honestly, it's the key to the whole market. And that secret? It's all about liquidity. Now, I know that sounds like some boring technical term, but trust me, it's not. It is the real game being played behind the charts. The real estate analogy on the screen is perfect. High liquidity means you can sell your house for cash like tomorrow. Low liquidity? Well, you're stuck waiting for a buyer. It's all about how fast you can get in or out without wrecking the price. So when we bring this idea over to the financial markets, things get, well, they get a lot more interesting. See, for the big players, the massive institutions, liquidity isn't just about speed. It's about a much bigger problem. How do they place a huge order without moving the price against themselves? They've got to manage that order flow super carefully, otherwise everyone will see what they're doing.
Right. So liquidity isn't just an on or off thing. It's a whole spectrum. At one end, you have the smoothest markets. Think major index futures. You can execute a huge position and the price barely even blinks. We're talking maybe a few cents of slippage. But then you move over to something less liquid, like options on a small cap stock. You try to sell that same large order and bam, the price can drop like a rock before you're even halfway out. That difference is literally everything.
And this whole thing creates two very different players in the game. On one side, you've got us, the retail traders. We're called liquidity takers. It's simple, right? To buy, we need a seller. To sell, we need a buyer. We take what's available. And on the other side, you've got the liquidity providers. These are the big boys, the institutions, the hedge funds, what people call smart money. And guess what? They're almost always the ones on the other side of our trades.
Okay, so let's put ourselves in their shoes for a second. Imagine you're a huge institution and you need to buy, say, $50 million worth of a stock. How on earth do you do that without alerting the entire market and sending the price to the moon before you're done buying? Well, there are two main ways they do it.
So they've got a couple of moves in their playbook. The first one is pretty straightforward. It's called trending accumulation. They just buy aggressively as the market moves up. But the second one, this is the sneaky one. It's called halt accumulation. This is where they quietly soak up all the sell orders they can inside a boring sideways range, trying to fly under the radar. But here's the real kicker. They only build up about 70% of their position this way. They always keep about 30% of their cash ready for the final critical move. And what they do with that last 30%? Well, that's where the magic and the trap happens. They literally weaponize that leftover capital to set the perfect trap. And guess what's in the crosshairs? Your stop loss.
So, here's how the trap is set. Step 1. The operator builds that main 70% position while the market is just chopping around, looking totally boring and directionless. They're just quietly absorbing all the sell orders, not making a fuss, not making any big waves.
Okay, then comes step 2. They take that 30% they've been holding back and they unleash it all at once. They just blast the market with sell orders, engineering this sharp, sudden, and incredibly convincing breakdown. It looks, for all the world, like a massive new downtrend is just getting started. And here's why that move is so brilliant and so dangerous for us. This fake breakdown is designed to do two things perfectly. First, it smashes through all the stop-loss orders from people who are already long, forcing them to sell. Second, it baits all the breakout traders. They see the big red candle and jump in short, thinking they've caught the big move. And just like that, you have a massive flood of sell orders hitting the market. And that is the liquidity the operator was waiting for. They can now easily buy up all those sell orders to finish building their full position.
But here's the thing. These liquidity grabs aren't random, not at all. The operators are smart. They're strategic. They set these traps in very specific, highly predictable places, places where they know tons of orders are just sitting there waiting to be taken. And we can actually break these down into three main hunting grounds. These are the spots on the chart where retail traders, almost by instinct, cluster their stop loss and entry orders. And that, of course, makes them the perfect targets. First up, major highs and lows. I mean, come on, it's the first thing you learn in Technical Analysis 101, right? Put your stop just above a recent high or just below a recent low. Well, the operators know you've been told that, and that's exactly why they go after these areas. They're just dense pools of orders. Number two is round numbers. There's just something about a big, clean number like 21,000 or 21,500 that acts like a magnet for our brains. People naturally place their entries, their take profits, and yeah, their stop losses right around these psychological levels. It creates another perfect concentrated zone for them to hunt.
And finally, number three, consolidation zones. Oh, this is the classic trap. You see the market goes sideways for a while, and what do traders do? They stack their stops just above the high of the range and just below the low. An operator can just push the price out one side, trigger all those stops, grab all that juicy liquidity, and then use that fuel to power the real move in the complete opposite direction. Okay, so now you've seen the playbook. You know how they accumulate, you know how they set the trap, and you know exactly where they go hunting. The big question is, how can you use this inside knowledge to flip the script and make sure you're not the one getting hunted?
All right, here's your action plan. It's actually pretty simple. First, get a feel for the major market trend. Then, literally mark these key liquidity zones on your chart, the highs, the lows, the round numbers. Now, when you see a super sharp, sudden move right into one of those zones, your first reaction shouldn't be to chase it. It should be suspicion. Ask yourself, is this a real breakout or am I watching a liquidity grab in real time? Don't jump the gun. Wait for the market to prove to you that it's not a fake out before you put your money on the line. So, I'll leave you with this. The next time you see that perfect setup, that powerful breakout or that sharp breakdown, I want you to pause and ask yourself a question. Am I about to make a great trade, or am I about to become the fuel for someone else's? Because understanding that difference, my friends, is what separates the prey from the predator in this